Okay, dear students, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, and today we are going to start pre-mock of December 2025 session. Question number 1, consolidation. Okay, and just for your information, this class is in English, but yes, this I have recorded this class for Hindi Urdu student as well. So if you are a Hindi Urdu student and you like Hindi Urdu very well, so it's better you attend the Hindi Urdu class. That is also available on my YouTube channel as well. Okay, now without wasting a single minute, let's move on to the question. Just for your motivation, my admin team has accumulated some of my position. This is not the total, exact total, okay, because some students scored in December 2010, 2011, 2011, 2009 positions, which we have not included because the years have been, big time has been passed. Okay, so you can see these are our position holders of only SBR. See, only SBR, right? So for FR level, TX level, the position holders are separate, and if we accumulate, it's 100 plus now. So you guys can also see, you can see from Kenya, Canada, different countries all over the globe. So it's a motivation for you that you guys can also be part of this list. Okay, and it's not impossible. These guys are all normal students. They also attended the same lectures, they also followed the same guidance. Okay, it's all about confidence now. Without wasting a single minute, let's move on to the question. This is the consolidation latest question with SOCI, income statement thing. Okay, so what they are saying, with Waitangi company is the parent of the manufacturer group whose financial year end is 30th September x6. So the major part, your accounting period ends on 30th September x6 on 1st October x5, exactly 12 months before the end of the accounting period. So this is not the question of mid-year acquisition of or part-year acquisition. This is pure complete first day of accounting period. Why? Because the accounting period is ending on 30th September and starting on 1st October. Okay, so Waitangi company acquired 80% of Zakira, 60% of Jenny, and 90% of Hassan. So all three of them are your subsidiaries. Apparently it looks like all three of them are your subsidiaries. All three of them are your subsidiaries. Okay, now we have following exhibit. The first one is related to fair value adjustment. So let's start with the first one. This is the first one. Okay, now on 1st October x5, when Waitangi company acquired control of Zakira, the net assets of Zakira had a carrying amount of 5 million and a fair value of 6 million. Okay, so you already know this is the requirement whenever parent company acquires S company. So parent company brings all the net assets of S company to fair value, and this process is called fair value adjustment. So from these two lines, it is clearly evident that there is a fair value adjustment of 1 million. It is clearly evident that there is a fair value adjustment of 1 million. There is a fair value adjustment of 1 million, right? Now the next thing is the difference between carrying amount and fair value related to property, plant and equipment that had a useful life of 4 years. Okay, so there is a 1 million fair value adjustment, and yes, it is a depreciating asset because the life is finite from 1st October x5. The fair value adjustment, very important, the fair value adjustment has not yet been accounted for. Now go slow, simple as that. There is a 1 million fair value adjustment, yes, and it's a depreciating asset, and the question is belong to income statement. So when the question relates to income statement, please listen to me. So in that case, The fair value adjustment never goes in the income statement, but yes, the excess depreciation, the extra depreciation. Why? Because in the books of S company, the asset is still at lower value, but for the purpose of consolidation, we increase the value. So we need to adjust this extra depreciation. This is extra expense. Extra depreciation means extra expense. Now, as a student, you may ask this question, sir, where to adjust this extra depreciation? See, they are telling you openly depreciation has been correctly classified as an operating expense. Okay, so they have included depreciation in operating expense. So now the excess depreciation will also be adjusted in operating expenses. Zakira's goodwill has been impairment tested and no impairment loss has arisen. So they have already done the impairment test, they have already done an impairment test, and no impairment is arisen. Okay, so there is no impairment and they have done it correctly. Now this is exhibit 1. Without wasting time, let's move to the requirement. This is the requirement number 1. See what is written. Using exhibit 1, explain how the fair value adjustment affects the measurement of Zakira's goodwill at acquisition and Waitangi company's consolidated statement for the year ended 30th September X6. It's 4 marks. Okay, so it's basically a theoretical question, but I'll explain you few things. Listen, hope you remember, this is C is equal to A minus L. You know the formula for calculating goodwill. The formula for calculating goodwill is cost of investment less fair value of net assets of S company. Cost of investment less fair value of net assets of S company. You will get final goodwill. Okay. Now, as you all know that in this question there is upward fair value adjustment of 1 million. Upward fair value adjustment. And how we do it? Fair value adjustment is like a revaluation. So you will increase your assets by 1 million, and when you increase your asset by 1 million, your net assets will also increase by 1 million. Okay, now come here. The formula for goodwill is COI less fair value of net asset. For example, your COI is 10. I'm taking dummy numbers. Fair value of net asset 5, so your goodwill will be 5. Okay, now what will happen when you will be doing fair value adjustment of 1 million? So your net assets are going up, so net assets will go up by 1 million, so automatically your goodwill will go down by 1 million. Okay, so what is the impact on goodwill? You have to write it. Your goodwill will be decreased by 1 million. Okay, this is the first thing which you have to tell to the examiner. The second thing which you need to tell to the examiner is 1 million means with 3 zeros. In 1 million there are 6 zeros, but this question is going without 3 zeros, so 1 million means 1000. So as this is the upward fair value adjustment of 1000, and this asset is a depreciating asset, so it has a remaining life of 4 years, so 1000 divided by 4 years, 250 per annum is your excess depreciation. Okay, now how you will be posting this excess depreciation in the income statement? Please, I hope you guys have done the basic income statement, basic consolidated income statement. Right now it's the revision class. Okay, so one thing is called face of the consolidated income statement. And in the face of the consolidated income statement, we post total figures. On the face of the consolidated income statement, we post total figures. Okay, so total figure is 250. So what you will do in the operating expenses section, you will increase your total operating expenses by 250. Okay, because the asset has gone up, so obviously the depreciation should also go up, and depreciation is an expense, so we'll increase the expense. Okay, so this is the first thing. But later on, what is the reality? As we all know, this asset belongs to S company. And when this asset belongs to S company, NCI is also the owner of S company. So we'll distribute this expense between parent and NCI. That means 80-20. With this subsidiary Zakira, the holding is 80-20. So what will be the entry? The entry is like this. Listen. Property, plant and equipment credit 250. And then retain earning debit 80%. 80% is 200. And then NCI is 50. Okay. So this is the real entry, and later on at the downward side of the income statement, when you have to show the breakup, at the bottom of the income statement, when we will be doing profits attributable and these things, you will have to show this breakup also. Okay. I hope you remember these entries. One thing I would like to add here, that I have recorded a separate class for consolidation double entries as well, and that class is also available at my YouTube channel in my LMS as well. So if you haven't watched that class, you can watch it. It's useful because now in SBR you have a pre-populated area for consolidation, so you must have good grip on double entries. Okay, now one last thing which I would like to highlight. Listen, what is written here: Zakira's goodwill has been impairment tested. They have already done impairment and no impairment losses arisen. Now what does it mean? Hope you remember IAS 36. For example, I'm using dummy numbers. Your carrying value of goodwill was 5, but the recoverable amount was 7. Okay, so now just think that recoverable amount is 7 and goodwill is 5. So whenever the recoverable amount is higher and carrying value is lower, no impairment. That's why they are saying no impairment. Okay, so but now after this adjustment, after reading the exhibit number 1, we just realized that our goodwill went down by 1 million. Goodwill came down by 1 million because of upward fair value adjustment. So now your new goodwill is 4 million. Now use your common sense. When this 5 was lower than 7, see, 5 is lower than 7, that's why no impairment. So obviously your 4 is also lower than 7, so no impairment. Just think, when the original 5 goodwill was less than 7, so no impairment. So now the goodwill has come down a lot. Now it's 4. When 5 is less than 7, so 4 is also less than 7. So you will say no impairment. You will be saying no impairment at all after doing this adjustment. So this was your requirement number 1. My dear students. This was your requirement number 1. Okay, now my objective, as this was your mock exam, you have to do it yourself, please. But my objective is just to give you understanding. So I have made the solution for you guys. You just need to read it out. And I'll also discuss the marking. It's a 4-mark question. See, in the calculation, this is the solution. Okay, be confident, please be confident. Confidence is the key for now ending days. In the calculation of goodwill at acquisition, the net asset of Zakira were understated by 1 million. Yes, they are telling you original story. Originally the net assets were down. Now we increase the net asset through fair value adjustment, and they should be at fair value rather than carrying a value. Okay, as a result, goodwill was already overstated. So now we need to decrease the goodwill, and we just did. The impairment review of goodwill has been conducted, this last thing which I discussed, and no impairment loss arises. Therefore, the correction of the overstated goodwill to smaller amount, I use the numbers, already it was 5, now it's 4, will not result in impairment loss. The correction of goodwill does not impact on the consolidated profit and loss. Okay, goodwill is done. Goodwill is calculated at acquisition date, so it has nothing to do with the income statement. Yes, I agree one thing, that the impairment of goodwill affects the consolidated income statement. That's true. However, the fair value uplift to property, plant and equipment give rise to additional, yes, additional, extra, excess depreciation affects the consolidated. Yes, see, this is 1 mark, this is 1 mark, 2 mark, then we have 1 mark, 3 mark. The annual depreciation charge of 250,000 is an additional 4 mark, but you will say that this is the question of 4 mark. Wait, since the additional expense relates to subsidiary that is 80% owned, the profits attributable to parent and NCI will be reduced by 20 and 50. I've even made the entry. So we have written total five paragraphs, and 5 paragraph means 5 marks. Okay, now 5 marks. Now as a student you will say that this question has only 4 maximum marks. Yes, there is a concept I have taught many times to you guys. There is a concept of there is a concept of extra headroom. Yes, the concept of headroom means if the question has a maximum marks of 4, examiner will start checking this question through 5 marks. So that means we have 5 marks, we have written 5 points. Now if 1 point is wrong, still you will get complete 4 marks. If you did wrong 1, still you will get complete 4 marks. So that's the beauty of SBR paper, headroom. So the maximum marks are 4, but examiner will start checking as if it is a 5 mark question. So first requirement is totally done, and I would say this was all related to basics of your SBR, basics or some F7 thing. Okay, now requirement number B. Using exhibit 2, we will just read. Okay, using exhibit 2, calculate the goodwill arising on the acquisition of Jenny and the impairment loss following the impairment review. Explain, see, we need to how this impairment loss should be accounted for in Waitangi's consolidated financial statement. Okay, 4 marks. Waitangi company acquired 60% of Jenny's 1 million equity shares on 1st October X5, paying consideration. See, 60% shares acquired, but the total number of shares are 1 million. So the subsidiary Jenny's has total number of shares of 1 million and we acquired only 60%. So that means 600,000 shares with us, but 400,000 shares with NCI. 400,000 shares with NCI. Be active. Paying consideration, this is COI. When the fair value of net assets of Jenny, very good, they have given you ready-made fair value of net assets. Jenny's share price on 1st October X5 was 4. Now let me tell you one thing, why they have given you share price of S company. They have given you share price of S company. They have given you share price of S company because they want you to calculate fair value of NCI at acquisition. They want you to calculate the fair value of NCI at acquisition. Okay, so very simple. Let me calculate fair value of NCI. See, total number of shares issued by S company is 1 million, and out of this 1 million, 60% shares with parent company. So that means 40% with NCI. So 1 million into 40%, it's 400,000 shares. Multiply by the share price is 4. So it's going to be 1.6 million. 1.6 million. Fair value of NCI is 1.6 million. Fair value of NCI is 1.6 million. So within seconds we can calculate the goodwill. Within seconds, yes, we can calculate the goodwill. Now, Jenny is assessed as a cash generating unit, CGU. Yes, hope you remember. I taught you this CGU 2 times in my regular classes. Number 1, when we were doing IAS 36. And number two, during consolidation, I also taught you the CGU, goodwill impairment calculation, if you remember. Now, and at the reporting date has a net assets of 10 million and a recoverable amount of 11.6 million. So now this last line is related to goodwill impairment calculation. Goodwill impairment calculation, don't worry, I'll do it. Okay, just the last thing I would like to say, just read the paragraph first or take the picture so that I can calculate goodwill for you guys. See this, the COI is 10 million. Fair value of NCI, I just told you 400,000 shares, multiply by the share, the price is 4. So 1.6 million, so it's going to be 11.6 million. Now fair value of net assets is 8 million. Okay, so this will be 3.6 million is your goodwill. 3.6 million is your goodwill. Okay, so we have just calculated the goodwill. Now the next thing, hope you remember, if you have taken the classes, so you must remember the calculation of impairment of goodwill using CGU method. So you know the subsidiary itself is a CGU. Subsidiary means a running business. Subsidiary means a CGU, running business. Okay, now what they are saying, carrying value of net assets means complete subsidiary net asset was 10 million. You can go and check then, but these net assets are always taken from individual books. These net assets of S company are always taken from individual books, and you already know in the individual books there is no goodwill, no goodwill included. So how much was the goodwill? It was 3.6. Okay, so 10 plus 3.6 is 13.6. Carrying value of CGU is 13.6. Now hope you remember the recoverable amount. The recoverable amount was 11.6. We have just studied. The recoverable amount of this CGU is 11.6. So the carrying value is higher. And the recoverable amount is lower. So there is a total impairment of 2 million. There is a total impairment of 2 million. Now use your brain. Now let's allocate this 2 million goodwill, 2 million impairment on this CGU. So the first step is you will cancel this goodwill, and yes, the goodwill is 3.6 million and your impairment is 2 million. That means complete impairment belongs to goodwill. Okay, so let's me make you the entry for goodwill impairment, goodwill credit. Now wait, basic, not advanced. This is the impairment of full goodwill method. This is the impairment of full goodwill method. Right? So in full goodwill method, the goodwill belongs to complete S company, that means NCI also. So the goodwill impairment will be distributed between retained earning and NCI. And yes, this time the holding is 60-40. For this, Jenny's holding is 60-40. So 2 million means 2000. So it's going to be 1200 and 800. But yes, one thing, wait. This is the question of income statement. There is one thing which we call face of the consolidated income statement. At the face of the consolidated income statement, you will be posting complete 2000 impairment. At the face of the consolidated income statement, you will be posting complete 2000. Okay, in operating expenses you will add. But later on, when you go down and you show the breakup to shareholders, so in that breakup section you need to distribute this 1200 and 800. Okay, 800 to NCI and 1200 is attributable to parent company's shareholders. Okay, Now this is the explanation. This was the calculation. This in this part you have to do calculation as well. See, so this is a 4-mark question. So like 2 marks or 2.5 mark is the calculation, and the remaining is the discussion. The impairment loss of 2 million is an additional operating expense in the consolidated statement of profit and loss and will reduce the carrying amount of goodwill. Yes, you know the entry, expense debit and goodwill credit. So the expense portion will go in the income statement, the asset portion will go in the SOFP. Since the NCI was measured at fair value of at acquisition, yes, the profit attributable to NCI will be allocated with their share. This, yes, we made this entry. See, for this thing I have already made this entry. I have already made this entry for you guys. I have already made this entry for you guys. Okay, so that's your total. 4 plus 4, 8 marks. You got 8 marks in your SBR paper. So treat yourself as a winner. Think as if you will definitely clear this paper for sure. So now we have the different requirements. C requirement. See this. Using exhibit 3, explain how the foreign exchange differences. IS 21 is coming. Easy version of IS 21, baby. Should be classified as Waitangi's consolidated statement of comprehensive income for the year ended 30th September X6 in accordance with IFRS 18, the new standard. Hope you have taken my classes. IFRS 18. So let's move to exhibit number 3 with confidence. Waitangi company has certain foreign exchange differences. Go slow. And these have all been correctly calculated. Okay, so first good news is that the calculation of foreign exchange gain or loss is correct, but the posting is wrong. I'll tell you the posting is wrong. Calculation is correct. And they have booked a net loss of 180,000. Net they have done net off. Netting off means there is one gain and one loss. They netted off. Okay. However, the directors have not applied the requirement of IFRS 18. It's a presentation standard. So they have done the mistake of posting in the presentation section and have classified all of the exchange differences as operating expenses. Okay. They have, that means this complete net 180,000 they have booked in operating expenses. Now let's decide they have done correct or wrong. Very slow. The foreign exchange difference comprise of 200,000 loss relating to overseas loans. Loans means monetary item. Loans means amount to be paid or received in fixed and determinable amount of money. So it's a monetary item. Okay, so monetary item loss should go in PNL. I agree it will go in the PNL, but after the introduction of IFRS 18, it will go in which section of income statement? That is a different thing that I'll tell you. And a 20,000 gain of the retranslation of 100% overseas subsidiary. Very wrong. This is very wrong. See, this stupid accountant, what he did, he booked the gain, foreign exchange gain on foreign operation. Subsidiary is a foreign operation in PNL. It should go in OCI. This should go in OCI. And you know, it should go in OCI if you have done IS 21. Listen, the foreign exchange gain or loss of foreign operation like subsidiary should go in OCI now, should go in OCI today, but later on when you will be selling this subsidiary, it will be transferred to PNL. This is the real story. Okay, so this 20,000 is a pure mistake. It will never go in the PNL immediately, it will go in the OCI. But this accountant has booked both of them in the PNL operating expenses. Okay, so now the first step is, let's separate it. See, there is a 20,000, 20 is your gain and 200 is your loss. First let's separate it. Okay, now what they have done, they have booked this 20,000 gain. Listen, gain, this is gain in the operating expenses. So how they have booked it? Listen, I have to plan the later part as well. When they have booked the gain in the operating expenses, this is a gain. So they must have reduced the operating expenses. They must have reduced the operating expense by 20. So for the correction purpose, because we are here to correct it, for the correction purpose, now we are going to increase the operating expenses by 20. Okay, so what is the treatment? Increase operating expense by 20, okay, by this amount. Now, and one more thing, and then first of all you will increase the operating expenses by 20. This thing is correct. Now then you will go to OCI, and in the OCI you will book this 20,000 gain, foreign exchange gain on foreign operation. That's it. Okay, this is done. Now come to this 200,000 loss. Yes, this is the loss of monetary item. Now I will teach you pure hardcore IFRS 18. IFRS 18 says, now after the introduction of IFRS 18, it's like cash flow. There are 5 sections: operating, investing, financing, taxation, and discontinued operation. These are the 5 heads of income statement. Okay, out of these 5 heads, listen, for foreign exchange gain, operating activities are residual section. It is a residue section. So first you have to see all remaining 4. If the exchange gain or loss relates to the remaining 4, then you don't need to book in operating. But if the exchange gain or loss does not belongs to any 4 of them, then it is a residue category. Go book it with operations. Okay, now let me tell you more things. For example, there is a guy who routinely deals in the property, who his primary activity to buy and sell property. So now the property selling and property gains will be his operations, because he's doing it routine. But if a guy is a teacher like me, my primary activity is teaching, or I have an institute, we are service provider. If we buy a building and we sell it, so for us it's an investment. It will go in the investing activity. You getting? Same is the case with banks. If a bank is giving loan to somebody, so it's the primary activity of the loan bank. So interest income will be the operating income for bank. But for me and you, I'm a teacher, or if a guy is doing manufacturing business, if he is investing in bank and getting interest income, so for him interest income is investment income. You getting? So if you see the scenario for this company, you can scroll up. This company is a manufacturing company. Okay, so if a manufacturing company is taking loan, so it's a normal loan, it's purely related to financing. So when this loan is a financing thing, so the interest is also financing thing, and the exchange loss is also relates to financing activities. So this exchange loss of 200 will go in the financing section. But this stupid guy has booked in operating. Okay, so what you will do, listen, as it is a loss, this 200 is a loss, so they have increased the operating expenses by 200. So you will reduce the operating expenses by 200, and later on you will go in the financing section, interest expense, and then you will increase your interest expense by 200. That's it. You will increase your interest expense by 200. That's it. Done. Okay, very simple words. Again, it's a 4-mark requirement. Listen, the foreign exchange difference on retranslation of the overseas subsidiary 20,000 should not be classified. Yes, it's not an operating expense, because it should not. Okay, this is 1 mark. Instead, the exchange difference should be in OCI, and as it's a 100% owned subsidiary, so no NCI, obviously no NCI. 1 more mark. Now, under IFRS 18, the classification of income and expenses is determined by the nature of underlying assets and liabilities. Yes, on which asset and liability you have invested rather than the nature of income itself. 1 mark. The operating category is a residual category, I told you, meaning exchange differences will only be classified in the operating category if they do not, please, if they do not meet the definition of other categories: investing, financing, income tax, and discontinued operation. The 200,000 exchange loss relates to an overseas loan. As Waitangi's business is manufacturing, not investing and raising finance, this expense must be classified in financing category. It's a normal business. So if a normal business takes loan, that loan will go in the financing activity. But yes, if a bank is take loan or gives loan, so it's operations for bank. Therefore, the exchange loss should be included in the interest expense. That's it. 1 mark. Again, as a student, you will say, sir, these are 5 points, so 5 marks. But the question requirement is 4 marks. Yes, the maximum marks are 4 marks. The maximum marks are 4 marks. But examiner will start checking as if it is a 5 mark question. So if you do 1 mark mistake, still you will get full 4 marks. Okay, now the last theoretical requirement, and then we'll be shifting to the pre-populated area, and that is very good. Sub to sub case, 7 mark. Explain how, using exhibit 4, explain how Waitangi company should account for the sale of 10% interest in Hassan in consolidated financial statement. Okay, so one thing I would like to tell you, see, I will show you, I'll show you the Excel soon. So this will come in the, listen, can you see the interest borrowings? This, in this section, we'll add the 200 thing. And from this operating expenses, we'll plus 20. Oh, sorry. We'll subtract 20 and then we'll plus 200. Okay. Because one thing was gain, this was gain, and this was your loss. And yes, you will come down here, see in the OCI section. I will teach you again in the Excel part, but right now I'm just giving you, see, exchange differences on translation of foreign, this 20 will come here. Okay, so 20 will be subtracted from here and it will be added here. Okay, so let's this exhibit 4. You know, in the Hassan company, we already had 90% shares. Okay, Waitangi company had purchased a 90% controlling interest in Hassan for 90 million. 90% for 90 million. 90% for 90 million. So a rough working means 10% cost 10 million. 90% for 90 million, so 10%. On consolidation of the subsidiary, non-controlling interest was measured at fair value. During the accounting period, Waitangi company sold 10%. Out of 90%, only sold 10%. So now we are from 90 to 80. We have sold 10. So previously we had control, yes, and now still we have control. Okay, so same thing. For 25 million, a gain of 15 million being the difference between the sale proceeds and the cost of shares sold. Wait, How did they calculate this 15 million? The cost of 90% shares was 90 million, so the cost of 10% shares is 10 million, and they sold it for 25. So cost is 10, sale proceed is 25, 15 million is the gain. This is for individual books, okay, not consol. Has been recognized in group equity and reported in the group other comprehensive income. Very wrong. First thing, listen. First of all, there are two books, individual books and consolidated books. Listen to me very carefully next 5 minutes. In the individual books, they treat this subsidiary as an investment, and normally they book it, they record it at fair value through PNL or fair value through OCI. Okay, so if you have recorded in any of these two categories in the individual books, and now later on you are selling this subsidiary, so this final gain always goes in PNL. In the individual books, this final gain always goes in PNL. This final gain always goes in PNL. Okay, right? This final gain always goes in PNL, right? So now just use your brain, just use your common sense. They should have booked this final gain in for the individual books in the PNL. They booked in OCI, so it's wrong. So we'll remove this 15,000 from OCI. But now will we book in the individual books PNL? No need in the individual books PNL. Why? Because we are making consolidated books. And yes, for the consolidated books, this is a very famous super hit case of sub to sub. This is a very famous super hit case of sub to sub. So for consolidated books, we'll apply the rules of sub to sub, and we all know how to do it. I will be doing it with you. Okay, so what first thing I'll do, this 15,000 they have booked here. See, they have booked this 15,000 here. See this, I will remove this 15,000. I will remove this 15,000 in the adjustment section. Okay, this is wrong. So your individual books and consolidated books both will be clean, and then we'll simply apply sub to sub case. Now they are saying, this is important, at the date of sale the net assets of Hassan were 170 million. The subsidiary's net asset was 170, the non-controlling interest is 13.5, and the goodwill was 10 million. Okay, read these two lines first. And don't worry about individual books. They did the mistake in the individual books, and through individual books they came in the consolidated books, and that we have reversed. So now we are just focusing on consolidated books treatment, and I'll teach you, and this is from 90% to 80% we are coming. Read these numbers. Okay, so when it is a case of sub to sub disposal, okay, sub to sub disposal, how you treat it? Hope you remember, originally we were at 90%, so NCI was at 10%. Now we sold 10% shares to NCI people, so we are at 80, NCI at 20. So definitely there is an increase in NCI. Now, how to treat this increase in NCI? Listen, how to calculate this increase in NCI? I gave you one. Just always recognize who is seller. Who is seller of shares? And in this question, honestly, the seller is parent company. Parent company is selling the shares. Parent company is selling the shares. Okay, so now from parent company point of view, you will calculate increase in NCI. So the complete company was in control of parent company, so net assets of complete company is 170 now, and you gave the 10% of this company. But as we are doing full goodwill method, so we have to give the share of goodwill to NCI as well. So goodwill is 10 in this question. So this is 180 million. Everything includes of this company, it's 180, and we gave away 10% to NCI. So 18 is your increase in NCI. 18 is your increase in NCI. Okay, now let's make the entry. See, we receive, when we sold the share, we received 25 million. So bank debit 25, bank debit 25. Okay, and then we have NCI is increased. So NCI increase, NCI is the part of equity, remember? So when NCI goes up, we credit it. Now you know the difference will go in OCE, not PNL. In sub to sub case, this is the transaction within the group. This is the transaction within the group, the exchange of shares, the selling of shares within the group. So this, in economic reality, there is no loss in control. There is just the percentage is changed. So this gain or loss will go in OCE. And you know, this OCE is not OCI. This OCE is not OCI. Why? As a student, you may ask, wait, let me go down to the basics of your F7 FR level. You know, in OCI only those equity changes comes. In OCI only those equity changes comes in which your owner is not involved. Your owner is not involved. The shareholders are not involved. But in this case, in this selling of shares, shareholders are involved. Shareholders, NCI and parent companies, these all are shareholders. So shareholders are involved. So this is not OCI. This is OCE, and this will directly go in the SOCI, statement of changes in equity. And in this question, you are not going to do OCI. You are not going to make SOCI, statement of changes in equity. Okay, so now once you have done this, now let's do the explanation part of requirement number D. Not difficult. See, this is the I have written 1 point with my pen as well. Waitangi's sale of 10%, it's a 7 mark requirement. So out of 7 mark, you can think 2 marks for this calculation. 2 mark for this calculation and entry. Okay. Waitangi's sale of 10% Hassan's equity does not result in the loss of control. Yes. From 90 to 80, no loss of control. Waitangi will still hold 80%. Hassan's remains subsidiary of the Waitangi, albeit with an increase in, yes, now the NCI is changed, 1 mark. From a group perspective, the sale of share is a transaction within group, so no profit and loss to the group will arise. Yes, no gain or loss will go in P&L. That's why I booked in OCE. The control to control transaction does give rise to a difference that is taken directly to equity. We just took it to OCE. This difference is between the proceed received and the increase in NCI. 1 more mark. The increase in the non-controlling interest of Hassan is measured as 10% of the sum of the net assets at the date of, and goodwill. Remember, I added goodwill as well. Goodwill is relevant to include as the non-controlling interest at acquisition was measured at fair value, full goodwill method. Remember, that's why we included it. Meaning that goodwill is full goodwill and is accordingly partially attributable to the non-controlling interest. Okay, 4 mark. Now wait, just a question. If this question was if in this question it's not a full goodwill method, if the examiner would have told you that this is not a question of full goodwill method, let us say it's a proportionate goodwill method, then we will not include this thing. Then we will not include this. Okay, right? This is the difference. Just telling you for the knowledge. Now the last thing, the gain of 15,000 booked by accountant in OCI is wrong, so it should be reversed from OCI in consolidated. This final gain of 15,000 should be booked. Just I'm telling you the real in P&L of individual books of P company. This is the real treatment. Okay, so it's complete 5 marks theory for you and with the calculation part. Now the last thing is left, that is pre-populated area. That is pre-populated area. Okay, now my dear student, they are saying about this. See the requirement. Adjust the pre-populated spreadsheet response. Okay, 11 marks. This is your last requirement, 11 mark, and this is the statement which I'll be showing you in the Excel area. Okay, so now what you have to post, just start counting. In number one, in adjustment number one, there was an entry of excess depreciation. We'll post that one. Then in adjustment number two, there was impairment of goodwill of 2000, that we'll post. Two things. Adjustment number three, there is this 20,000 gain and this 180,000, and then this 200,000 loss. This we'll post. Three things. Three. One is excess depreciation, we'll post in operating expenses. Number two, impairment of goodwill, we'll post. Number three, this area. Exchange gain or losses, we'll adjust. And the last thing is exhibit number 4. The only thing for exhibit number 4 we'll adjust is this 15,000. Is this 15 million, 15,000, this thing, only this thing. The remaining entries are not part of income statement. The remaining, see, this entry is not part of income statement, not at all. This all is SOCI, statement of changes in equity, not income statement or OCI. Okay, so count it. Excess depreciation will post, impairment of goodwill will post, the exchange differences area will post, and the number 4 is 15,000 error. These four things, just these four things we need to post, and that's it. Nothing else. Okay, dear students, so now we are moving towards the pre-populated area. Now what is this pre-populated area? You have already done it. See, everything what is written here in front of your screen, this everything will be given to you in the exam. All these things will be given to you in the examination. They will give you ready-made. Okay, now first of all, let's solve the top of this area. This top area is called the face of the income statement. And on the face of the income statement, we'll post total numbers, total figures. Okay, right? Now this I have already done myself. This adjustment number 1, 2, 3, 4, 5, and finally I have made the total column. Right? So in this case, in this instance, these numbers 1, 2, 3, 4, 5 you have to write in your exam, and the total column is, now again I'm telling you, it's optional, it's not mandatory, but if you have time you can make this total column. Okay, now let's start. The first thing we have to post is excess depreciation. The first thing to be posted is excess depreciation. So on the face of the income statement, we'll post total. And excess depreciation was part of operating expenses, and we need to increase our operating expenses. So you can see operating expenses are already in a negative sign, so we'll write with negative 250. Okay, so this we have done. The second thing is impairment of goodwill. The total impairment of goodwill was 2000, and right now we have to post total numbers. So again, we have to increase the operating expenses, and they are already in negative sign, so minus 2000. Then in the point number 3 and 4, the two errors. Number 1, you remember the foreign exchange gain or loss of foreign operation, the foreign exchange gain or loss of subsidiary. It should have been booked in the OCI, but this guy booked in operating expenses. So it was a gain. So when they booked the gain in operating expenses, they have reduced the operating expenses. So now for the correction purpose, we'll increase the operating expense, and we'll increase the operating expense by using negative sign. Okay, but this same negative 20 will come here. See as a positive 20 in the OCI, as a positive 20 in the OCI. Okay, now the second last thing, sorry. In point number 4, there was an exchange loss of a foreign loan. So it's a monetary item. they have recorded it in operating expenses. So first of all, remove from operating expenses. And when you remove it from operating expenses, so operating expenses are already with a negative sign, so we'll plus it. And then we'll go to the interest expense section. And yes, I have just explained you the IFRS 18, latest IFRS 18. This exchange loss on foreign loan will be part of interest expense. So yes, now negative 200 here. And the final thing, then the last thing is, see, this 15,000 in OCI they have booked wrong. This 15,000 in OCI they have booked wrong. So sir, just remove it. Already it's with plus sign, so we'll do it with negative sign. So yes, for the face of the income statement and OCI, we have done all the things. Now come to the total column. Come on. You will, as it is, you will write, then this thing will come as it is. Now equal sum okay. Then you have horizontally, we need to add equal sum okay. Now equal operating profit equal sum. I'm using MacBook today, so that's why there is no shortcut, right? Then income from associate will come as it is, there is no adjustment. Again, we'll use the formula sum sorry. Yes. Now with this $500 and $200, okay. Again, the formula of sum this tax will come as it is, no adjustment with the tax. Again, the formula sum $7,730 is your total profit, as if we owned everything. Right now it's total calculation, okay, as if we owned everything 100%. The NCI distribution is a later part. Now the next thing is, see, 15,000 minus 15,000 equals sum sorry this 0. Then this 250 revaluation gain on PP, this is perfect, there is nothing, examiner said nothing for this. And yes, this is a new correct 20 gain. So can you calculate total comprehensive income? This is other comprehensive income first. So 250 plus 20 is 270. And now if you want to add, you will write this is this plus 8,000. 8,000 is your total comprehensive income. Now till now we have done as if we own everything. Okay. So now we have done this income statement, the face of the income statement of consolidated income statement as well as OCI. Now if you remember the consolidated income statement format, so in the end you have to do these three lines. You have to show shareholders what is the breakup of NCI and profit. Okay, so first of all, see, it is written profit attributable. First of all we are doing this breakup for profit. So what we do, Listen, first of all, we'll pick the total profit. The total profit which we calculated is 7730. This is the total profit. This is the total profit. Okay, this is the total profit. Now, if we can calculate two out of these two things, NCI and profit attributable to P company, if we calculate one thing, the remaining thing will automatically come. So let's do it in the easiest way, and the easiest way is that first calculate NCI. Now wait, check this. Original profit of NCI is 1000. Can you see this excess depreciation? This excess depreciation is 250. This excess depreciation of upward fair value adjustment is 250. And hope you remember, I made the entry for you guys. So out of this 250, 250 is the distribution. Okay, 200 for parent company and 50 for NCI. So let's do it. 50 for NCI and 200 for P company. Now we are doing actual breakup of entry. Now same is the case with this 2000. This 2000 is the impairment of goodwill using full goodwill method. So with this subsidiary, the holding percentage was 60-40. So 40 means 800 will come to NCI and 1200 to be borne with parent company. Okay, so first of all, let's calculate NCI. Only these two things. NCI is 150, so 7730 minus 150. 7730 minus this cell. So it's 7580. Now one last small thing. Sir, you have solved it, but can you reconcile this number 7580 horizontally? Yes, I can, no problem. So this is the profit attributable to P company, 9000. Then 200 is the excess depreciation share of parent company. 1200 is the impairment of full goodwill method share. And then you have this 20. Can you see this 20? This 20 belongs to pure P company, so it will definitely hit your profit. And right now we are only doing profit. But this 200, listen, this 200 is just the reclassification adjustment, plus 200 and minus 200. So no impact at the bottom. Now, all of you, please take out your calculator. Just do what I say. Write 9000 first. 9000 minus 200 minus 1200 and minus 20, you will get 7580. Okay, so we have done this thing as well. Okay, now finally the last moments. The way you did the breakup for total profit, see, profit attributable to equity owners of P company and NCI, the same thing you need to do for total comprehensive income. Now again, the first step is pick the total comprehensive income. This is the total comprehensive income as if we own 100%. Okay, then now calculate the NCI. There is no, if you have seen the question carefully, there was no item of OCI. For NCI. Okay, but definitely, how to calculate total comprehensive income? Profit plus OCI. So profit adjustment will come as it is. This 50 and this 800. This will come as it is. So NCI will again be same for total comprehensive income as well, 150. So 8000 minus 150 is 7850. 8000 minus 150 is 7850. Right? Are you getting? Now, as a student, one last request from your side. Sir, can you prove this 7850? Yes, I can. Horizontally. Wait. First of all, what is total comprehensive income? Profit plus OCI. So all the transaction of profit will also hit total comprehensive income. So this, first of all, this 200, yes, it will hit. This 1200, it will also hit. But this 20 will not hit. Why? See, this is minus 20 and then plus 20 with OCI, so net impact will be 0. Here net impact will be 0. But this 15,000 purely belongs to parent company. This 15,000 purely belongs to parent company. Now my dear student, one last request, take out your calculator, and write in your calculator this first. 24, solve this horizontally, net it off this horizontally. 24250 minus 200 minus 1200 and minus 15,000. I repeat, 24250 minus 200 minus 1200 and minus 15,000, you will get this 7850, right? So that's the end of this question. Yes, I can understand the last part. For the last part, your mathematics should be very strong, no problem. Never ever go for perfection. If it is a 30-mark question and you score 22, 21, still it is good. Still you can easily pass, okay? Right? So this is the question, this is the solution. And yes, one last advice, I have written here adjustment 1, 2, 3, 4 and 5. You can write like this. Adjustment number 1, you can write fair value adjustment. Adjustment number 2, you can write impairment of full goodwill, impairment of goodwill. 3 is foreign exchange gain or loss on foreign operation. Then point number 4 is foreign exchange loss on foreign loan. And then point number 5 is sale of shares, gain on sale of shares. Okay, so in this way you can do it. Again, I would repeat that the total column is optional. There is no marks for total column, but yes, if you have time, it's better you make it, especially for the balance sheet question. Okay, so finally, that's the end of the class. Thank you and take care.